Here we have our Nike versus Under Armour financial analysis by Rachel Castelli, Stephen Howington, Gracia Roman, and Matthew Schmel. Here's the liquidity analysis, and we have two charts in comparison for Nike versus Under Armour for the years of 2014 to 2016. We've got the current ratio, quick ratio, and net working capital ratio. As we can see, Nike has a stronger current ratio. They will do better within a short-term period. Nike has a better liquidity position because the average quick ratio for the 3 years is 1.6 compared to Under Armour, who has an average quick ratio of 1.5. Nike also has a more constant net working capital ratio compared to Under Armour. So overall, Nike has a better, stronger liquidity analysis, meaning they have a better chance of converting their assets into cash to cover their short-term liabilities. Here is the profitability analysis, and we have another charts comparing the return on assets, return on common equity, gross profit margin, and earnings per ratio. Nike has an overall higher percentage in return on assets, meaning the company has a more efficient and better way of utilizing the assets convert into profit. Nike makes a higher average percentage in profit for its investors. Under Armour did better than Nike with gross profit by a small difference, and Nike did better with profit margin, meaning their sales exceeds the cost of the company.
This is Matthew Schmel, and I will be providing the analysis for the activity analysis and capital structure analysis. The first slide in front of you is the activity analysis. In order to demonstrate an organization's operational efficiency and profitability, an activity analysis is required. An activity analysis includes analyzing asset turnover ratios, account receivable turnover ratios, days sales in receivables, inventory turnover ratios, and days in inventory. In reviewing the relevant accounting periods for 2015 and 2016, both Nike and Under Armour would be classified as favorable. Both of their asset turnover ratios appear to be within the industrial average. During the last 2 years, Under Armour's account receivable turnover ratio has decreased, while Nike's account receivable ratio stayed steady. Despite Under Armour's decrease in the ability to collect cash, both Nike and Under Armour's account receivable ratios fall within the industrial average. One significant difference between Nike and Under Armour is their respective abilities to turn over merchandise inventory. Despite handling approximately 627% more merchandise than Under Armour, Nike is able to turn over their merchandise inventory approximately 4 times a year compared to 3 times a year for Under Armour. As a result, Nike is able to be more efficient and more profitable. Thus, it could be something that Nike makes a higher percentage of profits for its investors as a result. The next slide is regarding the capital structure analysis for Nike and Under Armour. A capital structure analysis evaluates all components of debt and equity used by a business. Overall, Nike and Under Armour appear to be in less financial risk when compared to industrial competitors. Furthermore, it appears that neither Nike nor Under Armour would have any significant difficulty in paying their liabilities. Between 2014 and 2016, Under Armour's debt-to-equity ratio increased to 0.79, while Nike's debt-to-equity ratio remained within the 0.70s before landing at 0.75 in 2016. Because the ratios are less than 1, both companies are financing more assets with debt than equity. Therefore, both companies are considered to have less financial risk. With regards to interest coverage ratios, which analyzes a business's ability to pay interest expenses, Nike's ratio has increased significantly to 244.32 in 2016. If the norm for United States businesses falls within the range of 2 to 3, Nike's interest coverage ratio clearly shows Nike would have little difficulty in paying off its liabilities. Under Armour's interest coverage ratio has actually decreased since 2014, but is still above the norm for United States businesses, period. It appears that Under Armour's decrease in interest coverage may be the result of Under Armour's increased acquisition purchases in 2015. In comparing Under Armour's interest coverage ratio to the industrial competitors, Under Armour would be more on the lower side. As a result, there is a potential for future difficulty for Under Armour to pay its liabilities, and is an item that should be further investigated moving forward.
This is Stephen Howington, and I'm going to be going over our capital market analysis findings. When looking at the price-to-earnings ratio, one company clearly stands out. Under Armour's average ratio over the past 3 years is well above the industry average. That typically means that the company expects to have an above-average increase in their earnings per share in the near future. Through our analysis, another key pair of findings were the dividend yield and dividend payout. What they showed is that Nike consistently pays dividends out to their stockholders, and stockholders generally receive a 1% return on their market value. However, the 1 year that Under Armour paid out cash dividends in 2016, stockholders received 5% of their market value, showing a better investment as far as dividends are concerned.
Hi, this is Rachel Caselli, and I'm responsible for the cash flow evaluation and the return on assets for both Nike and Under Armour. First, I'll start with Under Armour. Under Armour had a net income increase by 19.04%. Cash flows from operating activities have decreased. Investing activities accumulated from the purchases of new companies, land, and equipment. Dividends and long-term debts were paid during year 2016. Now for the cash flow evaluation on Nike. Nike had a significant increase in net income through year 2016, decreasing in accounts receivable, decrease in accounts payable, increasing in short-term investments, money obtained from stock operations increased, revenues increased due to selling of long-term assets. Now for return on assets, profit margin, and the asset turnover. Under Armour decreased 1.49%. Decreasing common equity results in lower profitability. Gross profit margin also decreased by 3.6%. Earnings per share also decreased. Now for Nike. Increasing ROA throughout these years, which increases in profitability through capital, from 27.82% to 30.12% increase in common equity throughout the years. Increasing gross profit margin, saved more earnings after cost of goods sold, which directly mirrors the increasing in the profit margin. Earnings per share also increased from $1.52 to $2.21. Thank you.